there, traders and investors. Greetings. Ben at TyndallTradingAnalysis.com. I hope you guys have been well. Today is Tuesday, June 15th, 2021, and this is your public market update. I do apologize for a lack of content recently. The markets have been pretty quiet. In fact, the last video update I brought you guys was May 12th of last month. Well, I guess that would be May. That would be last month. I almost said last year. May 12th, this is just over a month ago now. We were looking at a pullback in the S&P 500 that was kind of finding some support here at around 40.54 up to 40.87. We had a really nice clustering of fib support there that we did expect to give us a response and a move back to the upside. And while we have seen a move back to the upside, let's go ahead and put this chart aside, and you can see now where we are. I'll demote this entire uptrend 1 degree so it matches the same degree of trends that you see here, up in 1, down in 2, up in 3, A triangle, B, up in C to complete a B wave of an overall wave 4 flat. We got 5 waves into our fib clustering, and we have seen a response out of that zone. Let's see, over in the NASDAQ, we were looking at this as 3 down, 3 up, looking for a move down to maybe 12,681, and then looking for a response. So here's the S&P 500. We did manage to defend and hold that clustering of fib support. Here's your 1272 external retracement of the B wave. So there's the 4086, 4087, and there's your 4054. Now the move off of the lows has been very, very tricky. I've been pretty confident in my interpretation of the indexes on the move here out of the March 5th low. I brought you guys a video on the March 25th breakout suggesting that was a wave 2. I brought you guys a video out of the wave 4 saying that that was your support zone. We were looking for that move up. We've seen a move here in the S&P to the upside of about 4.8%. But now we are up against kind of an interesting situation. We have seen recently upticks in inflation, which Jerome Powell and the Fed continues to suggest is temporary, is transitory in nature. These are just simply a combination of supply chain constraints, further compounded by pent-up demand as we reach widespread inoculation and everybody's vaxxed up and ready to get back to work and go have fun. Well, the market has been on hold. Okay, we've been watching the bond market. We've been watching the dynamic at work there, and we're now up against a Fed meeting. We've seen some recent upticks in inflation, as evident in the PCE and CPI reports. We had PPI this morning coming out a little bit hot as well. But these have been reports that have been really expected. We expected these to be hot. And so the market really didn't react one way or another. We haven't really seen a decisive move yet. And given that this is such a unique situation because you have not only the supply chain constraints and the pent-up demand, but then you have the semiconductor shortage on top of that. Take the uptick that we saw in used autos, for example. You might be thinking to yourself, my goodness, what a year-over-year uptick in used autos. What's going on there? Well, it's actually 2 things that are going on. We have, number one, cars have a lot of semis in them. They've got a lot of semiconductor chips. Number 2, rental agencies during the coronavirus pandemic actually liquidated a good majority of their rental fleets. And now that the economy is coming back online, we've got the reopening talks about, they're attempting to fill that void. And unfortunately, auto manufacturers are not able to meet the demand. So not only are they unable to meet the demand, and we've seen a lot of auto manufacturers scale down production as a result of this semi shortage, the rental agencies have turned to the used auto market to fulfill their needs. So kind of interesting there. A lot of this really is a result of supply chain issues and pent-up demand, a combination there of both. But what I think the Fed might not be accounting for is a lack of people returning to the job market. So labor force participation not quite meeting the current jobs on offer presents the possibility of wage inflation. So, it's a big question mark. It's a big picture puzzle that I think is very difficult to forecast with any degree of certainty. And when that's the case, we use the hard right edge of the chart. The hard right edge of the chart, often your best forward leading indicator. So let's see what the bond market has to say about tomorrow's Fed meeting. We had some interesting commentary from Paul Tudor Jones this week. So I'm very curious to see what the Fed does tomorrow. I don't think they're going to move. Could they potentially hint at a policy change? Perhaps. Right now we're pricing in about a 7% chance that the Fed hikes. So highly unlikely, but we'll see. All right, back over to the charts. This is the current chart that I'm tracking, that this is some sort of a way for the contracting nature of this pattern suggests to me that we could be in for a move back to this support zone prior to achieving these upside objectives. I'll continue to keep you guys updated. The last update I brought you guys, I've had some good updates along the way, I think, and I've been trying to do the best job that I can guiding you guys. If you want to stay up to date with us full time, you can join us at tradinganalysis.com. I do put out nightly video updates for our subscribers. So Sunday night through Thursday nights. So this is the S&P. Let's go take a look at the NASDAQ. Taking a look at the NASDAQ, let's go over here and take a look at what we had tracking back in our video. So we were looking for this C wave to complete and then resolve to the upside. Now we have seen a resolve to the upside here, and we've nearly completed a 5-wave rally. So I would be expecting some sort of a corrective pullback. We talked in the last video last month about the weekly Elliott wave interpretations that we're currently tracking. And what we noted for you then was the XLK clustering here at 142.57. You can see we're kind of back into this contracting channel. Could we potentially be in for a larger corrective pullback? I do still see a larger wave on the horizon for growth in tech, but I don't quite think we're there just yet. The resolve to the upside that we've seen in semiconductor stocks is also a very interesting dynamic currently at work. This is a nice sideways consolidation moving higher. We've nearly completed 5 waves up here, very similar to the NASDAQ, so I would be expecting a pullback here as well. So that's kind of the situation. Let's now take a look at 10-year yields. Let's look at 30-year yields, and then let's look at how that fits in with the 20-year bond count. So over to the 10-year yield count, which this particular Elliott wave interpretation is a little bit interesting in that, number one, I typically don't give a lot of weight to the Elliott wave count of the rates, of the yields here. Whereas tracking the bonds themselves, price action in bonds, you have a higher degree of conviction that those patterns are going to unfold. But what we're watching here in the 10-year yield is this. Back on March 17th, I put out a chart on my Twitter suggesting we had some resistance up here at 1.75%, and that's where we expected the 10-year yield to find resistance and reverse course to the downside. We did find resistance at 175, and we've now seen a really interesting corrective pullback. So let's zoom in on this. We're looking at a 195-minute chart. I'll just go ahead and delete that. So what we have here on the 10-year yield count is some very interesting fib at work. You have the quality of this Y wave, this orange Y wave compared to W. You have a quality of C and A, and then you have the overall 4V2 equality, essentially telling you that wave 4 is equal in magnitude to the wave 2 counterpart. So this clustering of support is offered from 3 degrees of trend. You have C versus A, Y versus W, and 4 versus 2. This support clustering in the 10-year yield has delivered an impulsive 5-wave response. So down on the 15-minute chart, we'll go ahead and hide these ratios. We're attempting an impulsive reversal out of this zone. So that's interesting and is something I'm going to continue to watch into tomorrow. So the question now becomes, is this massive clustering of support going to hold? Are we going to see the 10-year move back through 175 and up to 2%? Or should we just simply dismiss the implications of the chart? Well, the market's been on hold, kind of awaiting an answer to this question. I think we're going to see a decisive move tomorrow. Now, based on some of the underlying flows of the market, including some of the bullish options activity, we're seeing a ramp back up in call buying interest. So this is the put call ratio inverted. Green line represents a 9-day simple moving average. Typically speaking, we use this as a contrarian indicator to substantiate market tops and market bottoms. We noted a lack of confirming call buying interest. The last confirming market top was back in December of last year. But here we are once again. The market just set a new high. Call buying set a lower high. So this is technically divergence, but we are starting to curl back up. So that's the 10-year, the TYX trading 2.2, excuse me, the 30-year. We're now into the 30-year. We went from the 10 to the 30. So on the 10-year, we've got the cluster. Let's go look at the 30-year. My goodness, I was hoping I didn't miss the sleep through, I don't know, months of trading action, and the 10 years trading at 2.2%. So the 30-year, coincidentally enough, is also trading an interesting corrective pattern. From the March 18th high, you have 3 waves down, 3 waves up, which, by the way, the time elapsed in this X wave was equal to the time elapsed in the W wave. Then we have 3 waves down. Also, the Y wave was equal to the W wave. So a lot of symmetry at work in this particular pattern. That took you into about 161% time relationship to the wave 2. And check this out. You have the 3 degrees of trend offering your clustering of fib support. You have C versus A equality. You have Y versus W at 2.13, and you have your overall 38% retracement of the third wave at 2.13 as well. So there's your downside support line into the clustering, yielding an impulsive response higher. That same dynamic at work in our 10-year count. Now over to 20-year bonds. Looking at 20-year bonds, what do you know? We see 3 up in W, 3 down in X, and 3 up in Y. You have the symmetry at work. You've got equality of your time elapsed in these 3-wave corrections. You've got C versus A. You've got Y versus W. You've got your 38% retracement. So is the bond market seeing something that the rest of the market isn't? And does the bond market see this as getting ready to break lower in a wave 5 position? I'm looking to hopefully come to some sort of conclusion one way or the other when we get through tomorrow's Fed meeting. But that's the situation right now. We're kind of on hold. We're waiting for this chart to either speak or we dismiss it entirely. The alternate interpretation for the TLT 20-year bond ETF is the idea that off of the March high, we did 3 of A, 3 of B, and a measured move down in C. But for the time being, this does not look impulsive. Could it turn impulsive? Absolutely. So the concern being counter-trend price action to the downside in yields, to the upside in bonds, given their inverse relationship. So let's see what happens. We'll keep you guys updated. We'll take you through this one wave at a time. I hope you enjoyed the update. I do apologize for a lack of updates recently. You know, maybe we're ending diagonal and we're going to move back to 40-50. Let's see what tomorrow brings. If we get a decisive move into tomorrow, I'll keep you guys updated, and I'll be back with you probably on Friday. All right? Thanks again so much for tuning in. You can check us out, tradinganalysis.com. If you did enjoy the video, please give it a like. Lets the YouTube algorithm know that you're enjoying the content, and it helps distribute it accordingly. We would ask that you subscribe with notifications so you can stay up to date. Yeah. And again, check us out anytime, tradinganalysis.com. Thank you guys so much. Have a good one. We'll see you on the next video update. Cheers.